All right, thank you everybody for attending today. We have with us Jim Musgrave, and he's going to be presenting a session today. And so from that, I'll let Jim take it away.
Great, thanks Caleb. Hey everybody, my name is Jim Musgrave. I am a financial advisor and also the regional president of a nonprofit called the Society for Financial Awareness. This is actually my third time coming out to the advisory board doing this workshop. And we also have another workshop on next Tuesday with a good friend of mine, Tyler Borowitz, going to be talking a lot about the mortgage, the whole process of buying a house and what you need to do for mortgages. So if you guys have any interest in that, please come and attend the workshop next Tuesday. I believe it's at the same time, 11 to 12:30 Eastern. So just to kind of briefly introduce myself, this is my new website, thesofa.org, and you can, again, so at home, if you want to kind of go to some of these websites and save them, I'm just going to be giving you a ton of great information. So, but again, you can also look at on SOFA and see about us, and you can also see the different seminar topics. This is the one that I'm doing today. What's interesting, we've been around since 1993, and you can see there's 17 pages of places that we've been all across the country. So we've helped a lot of people over the years. And I also have some great information on my website. So I've been in the financial business for over 17 years, and my website is jimmusgrave.com. And one thing is I actually recorded a video on how to fill out the financial spreadsheets, which we're going to do today. And so you can go right to my homepage and actually hit play and actually watch my video. So it's pretty neat. So if I go through some and you need to go back, then I got a great video right here. And actually a lot of the resources that I'm going to be talking about are right here on my Information Resources tab. And so if you want to download your actual financial spreadsheets, they're right here. We have the R-Factor questionnaire. For the people a little closer to retirement, I have a Social Security order form. And if you want to do comprehensive planning, I actually have a number of different questionnaires that you can fill out. That's the information you need to plug into the planning software to help figure out all those retirement things. But the demographics typically with the advisory board are fairly young, so that may not be applicable today. So I'm going to kind of jump right into this stuff here. So basically, initially this is a two-part workshop, but I'm going to combine parts A and B all in one today. So what we're going to do is we're actually going to go over overall financial planning, and we're going to fill out the R-Factor questionnaire. I think everybody should have been emailed that. And for the people here live, we actually have hard copies, so you can actually fill that out here. So we're actually going to talk about what's important to you, and we're going to identify some of the dangers, opportunities, and strengths that you have. We're going to talk a little bit about financial advisors and also the financial planning process. A number of you have probably never worked with a financial advisor before, so why do we exist? How can we help you? How do you do your due diligence to try to find a good one? So I'm going to give you some great resources like that. So when it all comes down to things, you've got two choices. You can either try to do all this on your own. I'm going to share with you tons of great resources, or you could work with somebody that is an expert in this and can help you save time and really get a little deeper into things. So the second part, which we're going to cover today as well, if I can get my little mouse, there we go, is yeah, part one, here's part two. So we're actually going to, again, go over the blueprinting exercise and the process. And we're actually going to spend probably the rest of the time filling out the financial spreadsheets. And as I go through them, we're going to identify the different weaknesses that you have, some of the things that I've seen out in the field that would be able to help you out, different techniques to build wealth and reduce debt. And really what the goal is that you've identified what's important to you, and then you're going to take a snapshot. I'm going to help you take a snapshot of your finances. And that's step 1 and 2 within the overall financial planning process. The next step is to kind of analyze what you have. And then once you kind of analyze all the different pieces of the puzzle, then only after you've done that, you can kind of create your own financial roadmap, which is what the goal is. And so, what I've seen out there, with a lot of your coworkers, is some of the common themes is there's a ton of student loan debt out there that people need to pay off. Saving for a house that you mentioned. Just general wealth creation, like how much should I put in my savings? Should I put money in my 401k versus paying down my debt? Make sure that you have the right insurance, those sorts of things. So we're going to touch on all that stuff today. And then at the end, while I go through this, I'm also going to be kind of going back and forth and showing you some great websites, some great free resources that you can go to get answers to a lot of questions. So the first thing we're going to do is actually go open up your R-Factor questionnaire. And so for you guys here in class, why don't you actually grab that piece of paper and a pen, and you guys on the call, hopefully you have the Word document in front of you. So if you want to kind of minimize the screen that watching me, and so you can actually kind of type in the Word document, that might be a good way of doing it. But you know, the question is, I want to get you to kind of think about your future. And so if we were to meet here 5 years from today, and you were to look back to today, what would have to happen during that period of time for you to feel happy about your progress? And I typically break that down into your personal life and also your professional life. And so what I'd like you to do is take 2 or 3 minutes, and I want you to really kind of think about in the next 5 years, what has to happen for you to feel like you're really making progress in your life. And I'm going to kind of be quiet for the next 2 or 3 minutes. I'm going to give you some time to kind of think about that. So again, fill out the part. So what needs to happen in the next 5 years for you to really feel like you're making progress? So what might be helpful is be as detailed as possible. So if you want to go on 1 international vacation a year, write that down. If you want to pay off your car or buy a new car, or save for children's college, or pay off debt, be specific. I'll give you guys another minute or so. I don't want to rush this because this is every financial decision that you make in life is influenced by what you're writing on your paper right now. I'll give you guys another 30 seconds. Are you guys good, or want to move on? You need a little more time? Need another 30 seconds, or are we good? We good? You guys online good? Do we need a little more time for this, or you want me to move on? Okay, so I'm going to move on. Okay, so now we've identified what's important to us. We need to identify the dangers that could potentially get in the way of reaching those goals. And again, I just put a number of bullet points here. So if you got a piece of paper, just you can check in one of these bullet points the things that you think are some of the dangers that will kind of get in the way of you reaching. I think not enough time is a big issue for everybody. Not sure how to reach the goals. There's all sorts of stuff. And if there's some dangers that I don't have listed right there, there's a little space to write in some of the things that you feel are kind of going to get in the way of you reaching those goals. This is critically important because you need to identify the things and figure out a way around them. And some will be easy, some will be more difficult, but just identifying some of these dangers is very valuable and very helpful. The thing I found just doing this for so many years is this, I think just kind of making financial planning a priority is one of the biggest hurdles I've seen. Life has a tendency to pull us in many different directions, and financial planning isn't nearly as fun as going out to a nice restaurant and having a glass of wine with friends. So, so just kind of making this a priority is a big one. So we look at some of the opportunities. So do you guys need more time on the dangers? Okay. In terms of, so what are some of the opportunities that we have to focus on to address the dangers? And I just kind of alluded to that. I think blocking out time in your calendar is probably the easiest thing that you can do. I tend to do a lot of stuff on Saturday mornings after I've had my cup of coffee and read the paper. I'll go down on my computer. I will, enter all my bills into Quicken. I'll update stuff, and I'll just kind of take a snapshot on things. So sometimes just a quiet time on a Saturday or Sunday morning can be a good time because the phone's not ringing, and so just kind of blocking out time in your calendar is a good thing. The second bullet point is called fill out the model day calendar, and all it is, I have an Excel spreadsheet that breaks down every hour of the day, and what I find, and I can email to you guys that, all it is that we have multiple things that we have to do at any given time. And so sometimes, if you can block out a time to do one little project, okay, I'm going to spend an hour on this, I'm going to spend an hour making calls, I'm going to spend a time following up on this, spend a time, do whatever. So you do these little blocks of time that are very helpful. It's just a time management skill. That's good. Again, identify the dangers, opportunities, and which ones do you want to address first. So that's important. So identify those dangers and let's focus on those. To fill out a blueprinting exercise, so this is just, the R factor is a general kind of broad thing. If you want to get more in-depth, I have a blueprinting exercise on my website that you can download, and it's great because it gets into like serious soul-searching stuff. So that's also very good. Also, you can work with counselors, teachers, coaches, parents, even advisors to help you with your goals. So those are some of the opportunities that we have. And so in terms of the strengths, jot down what are some of the things that you like to do. And so some of us are detailed-oriented and some of us are not. So what are your strengths? What do you like to do? And so people tend to focus on and do the things that they like to do. They tend to procrastinate on the things that they don't like to do. So if you know that there's something important that you have to do but you just hate doing it, then let's figure out a way to tackle that. Can you delegate that to somebody? Or if you hate to do something, like taxes, for example, no one really enjoys doing their taxes. But that's where you can say, okay, I'm going to block out time on this Saturday or Sunday morning. I'm going to pull stuff together, and you just focus on it. Just what we call eat the frog. Just get it done as quickly as you can and move on. So, write down what your strengths are, what things you like to do, what you hate to do, and what you can kind of delegate to others. Okay, and here we go. All right. So I'm just going to talk a little bit. So we talked about the R-Factor questionnaire. First of all, does anybody have any questions at this point? Is this so how often do you guys actually like fill out your, do you ever fill out like New Year's resolutions in January? Okay, well, great. We actually got you to do something that you don't do at New Year's. Well, this is good. All right. So as I alluded to before, you have a decision. You're either going to have to do this on your own or work with an advisor. So I'm going to kind of talk about advisors just to give you general information, and you do whatever you want to do. But so I also have a little piece that I can email you. Actually, do you know if you emailed the Harry Dent piece why you need a financial advisor?
I don't think we did.
All right. Anyway, I can get to that to you. But basically, the bottom line is that this stuff is really complex. So we're a month into roughly a new administration, and there's a lot of changes. So one thing that's a constant is constant legislative changes and tax changes and geopolitical changes. We don't know what is going to go on with the healthcare system. So the Republicans want to repeal the Affordable Care Act. So how does that affect your health insurance? So stuff is complex, and things are certainly challenging, and it's a full-time job for us professionals to keep up with this stuff. It's very difficult for people who are not financial advisors to kind of keep up with it. The other thing, too, is that Social Security and Medicare, although for many of you this is way, way down the road, but I actually, anyway, studied a ton of material for certification for Social Security, and it's a lot more complex than you think. So these entitlements, such as the Social Security and Medicare, are very complex. Again, we have the healthcare stuff. The credit cards, mortgages and student loans and car loans. This can also be complex. One of the most important things is your credit score. Well, how do you repair it? Well, how do you get good credit to begin with? One of the things is that just talking about credit cards and credit, what the credit cards want to see is that you actually can put stuff on a credit card or have some sort of debt or liability and be able to pay it off on a regular basis. So that's what they want to see. So if you've never had a credit card before, you may have a lower credit score just because you don't have a history of credit. So credit cards can be really good or they can be horrible. Credit cards are good because they're convenient and they allow me to kind of track things, but I pay off my cards every single month, so the interest rate doesn't really matter if you're paying them off every month. Where it really matters is when you're not paying, you have that outstanding balance. And so the credit cards stuff is, so the debt and credit, how to reduce the debt. And again, we're going to talk a little bit more about that today. And also, if you guys can make the workshop next Tuesday with Todd, he's going to talk a lot about the mortgages and the best way to kind of deal with that. Also, investments, stocks, bonds, cash, annuities, and alternatives, investments, annuities, and real estate. This is an area that I specialize in, and this is, and I say this with complete honesty, the more experience and knowledge that you have about investments, the more you realize how much you don't know. And you're talking to a guy who's a fiduciary and a registered investment advisor who manages tens of millions of dollars of my clients' money. The investment stuff is tricky. It's constantly shifting, and just putting money into a target date fund in your 401k isn't necessarily the best answer. For those of you who are trying to save money for, let's say, a down payment on a house, for example, or to kind of build savings, and you don't want to make, half of 1% in your savings account, the fixed income, like your typical bonds, yeah, you can go to Vanguard or T. Rowe or Fidelity and get a no-load bond mutual fund. That's fine. But what happens when interest rates go up? So, Yellen has been talking to, Congress, 2 days this week, and we're expecting another 3 rises of the Fed raising interest rates. So how does that affect bonds? So the answer to that question is that as interest rates go up, bonds go down. So how does that relate to you saving in your quote-unquote safe money? Well, that means that there is more risk in bond portfolios. Out of curiosity, you guys here in the room, how many of you guys feel that bond mutual funds can lose value? Do you guys think bonds can lose value, or do you think they will stay stable and you'll always make money? They can lose value. That's right. So one of the tricky things is about what we call safer money is that it's not necessarily as safe as you think. And 2013 was a perfect example where the interest rates went up, bond prices went down considerably. So you got to be aware of what you own in your bond funds. And so, the divesting stuff can be a complex topic. So this is one area that a financial advisor can really help you out. In terms of the insurance stuff, met with a number of your coworkers who, young families, they just bought a house and have a child on the way or have small children, but they don't have any life insurance. So the question is that, okay, so now you're strapped with a mortgage and you've got a family and you're relying on two incomes to pay the bills. So what happens if spouse A dies? Besides being an emotional wreck, the surviving spouse now has to deal with all the bills and now half the income, in which it could be financially devastating. So make sure that you have the right insurance is really important. And so even just some inexpensive term insurance, like a 30-year term policy of like $500,000 is not that expensive, especially when you're young and healthy. So it's just making sure that you've covered your risk. This falls under the umbrella of risk management. So are you taking advantage of the flexible savings accounts? Do you have HSA accounts here? Again, I'm not familiar with the health insurance that advisory board does, but being able to look at that stuff is important. Are you taking advantage of the disability, but there's both short and long term that advisory board offers? So again, just make sure that you have the right insurance policies. Is always good to kind of review this stuff. And again, what also financials do is that, I work in two markets. I work with individuals like yourself, but I also do a lot of work with business owners. So I set up a lot of 401k plans, and so these are other areas that financial advisors can help you with. So just a couple more bullet points. So obviously, when you're dealing with, I'm going to kind of take you through the financial roadmap kind of process today, but once you've gathered all this information, what are you going to do with it? So that's one of the things that we can do is kind of help with reaching those goals. Again, if your situation changes, there's a death in the family, was somebody disabled, did you lose a job, were you married, divorced, is there inheritance? Those are life-changing events that can be kind of challenging to deal with. I think this is a big one. So when I first got in the business back in the late 90s, I had a mentor. He said, my dad always told me it's not the bus you see, it's the bus that you don't see that gets you. And it means like, so you don't know what you don't know. And that's one of my biggest fears, especially when you're dealing with financial stuff or anything, is that you don't know what you don't know. And that could, and making decisions with not enough information can be very, very costly, and we want to make sure that you avoid that. So that's really important. The other thing is that you don't have time or the inclination or expertise to manage your own investments. That's a big thing. I've got a number of very kind of high-powered clients with very large portfolios, and they don't have time. They're very, very smart people. They just don't have time to manage the money. So that's also important things. And also, just comprehensive, well thought out planning should determine what type and how much insurance and investments you own. So that kind of gets into a little bit of different people in my industry. So I'm going to get into this a little bit. So if you wanted to, say you want to quit your job and you want to get into my business, you get your health and life license, you can get your securities license and your Series 63, 65, and you can actually charge fees for your advice and to manage money. There are a number of people that will just maybe have an insurance license, but they kind of put themselves out there as retirement experts. and the only thing that they do to help people out is sell them annuities, which aren't necessarily bad, but that's the only tool they have in their toolbox. So you've got to be aware of who you're working with and what kind of qualifications that you have. I'm going to go into that a little bit more on actually. So if you want to interview, do due diligence on an advisor, I'm going to kind of share with you some resources for that. So again, if you do interview an advisor, here's some of the questions. Again, this is all in your handouts, but I'm just going to hit this quickly. One is that, are you a fiduciary? And I can kind of explain what a fiduciary is. A fiduciary is a person that legally, when they make a recommendation for you, whether it's in investments or financial planning, they have to make a recommendation that is in your best interest. They cannot make a recommendation that makes the advisor a lot of commission that's not necessarily in your best interest. So we are fiduciaries in our firm, and so we are always make the decisions or recommendations based on the best interest of the clients. So, and then there's a big push right now with the Department of Labor that they're trying to protect people that are close to retirement. They have these nice big 401k plans. They want to make sure that when they meet with an advisor that they're getting good advice, and there's a lot of 401k rollovers into individual IRAs. They want to make sure that people are getting good, unbiased advice on what to do with those big 401ks. And again, for many of you guys, it's going to be decades down the road, but there's been a push from the Department of Labor to implement the fiduciary rule, which is really, really important. Again, how do you charge for your services and how much? Again, are you commission-based and you have to sell a product to make money? Or are you fee-based where you charge a fee to do planning or to manage money? So that's an important thing. And really what the industry tends to do is we tend to go more fee-based, which is quite frankly more fair to the client. What licenses and credentials and certifications do you have? That's also important. What services do you provide and your firm provide? What types of clients do you specialize in? Can I see a sample plan? What is your investment approach? You're going to see a lot of differences within your investment approach, and we'll talk about that a little later. How much contact do you have, with your clients? Do you just, set up an account and never hear from you again, or are you proactive when the market drops and say, hey, this is what you need to do to protect your money? So, have you ever been publicly disciplined for any unlawful or unethical actions in your career? Okay, that's kind of important to know. Are you working with somebody who's kind of straight up? And so anyway, what I want to show you real quick here, while I'm kind of talking about this, I'm going to kind of move on. I just think it's important that you know the resources to do your background check. Write down this website or save it in your computer. It's called FINRA.org, FINRA.org. Just write it in your handouts or something. Okay. FINRA is the organization that oversees financial advisors. Okay, and they have great information. If you see right here, they have a whole section on for investors. What you should know. So you have, anyway, what I suggest you do is to go through all these different tabs right here. They also have tools and calculators to do things. And kind of relating to, if you're going to interview a financial advisor, there's a thing called Broker Check, which, by the way, right here on the home page, you can go to Broker Check, and you can click right here, and you can actually type in the financial advisor's information and look them up. So anyway, so this is another resource that, again, if you're going to do your due diligence, hire an advisor, this is a good place to go. Okay? So I didn't want to spend a whole lot of time on this, but I just want to make sure that you guys have the resources available to do your due diligence. Any questions at this point? Okay, do we have any questions on the chat? Okay, so guys online, if you have any questions, you can always type in the chat room, and Caleb will kick me on the table and say, hey, you got a question. I'll be happy to answer it for you. Okay, so what are we going to talk about next? So I'm just going to touch real briefly on the financial planning process, and this will take about 2 minutes. We're going to get into the spreadsheets. So this is straight out of the Certified Financial Planning material. And so when you meet with an advisor, and I'm going to take you through steps 1 and 2 today, this is the actual 6-step process to do financial planning. So 1 is to establish and define a client-advisor relationship. And again, that's where the advisor explains his or her planning services and define each of your responsibilities and so forth. It's kind of sort of a get-to-know-you kind of rapport-building kind of part. The second is to, and also this is where we kind of go through sort of the R-factor stuff, like what's important to you, how can I help you, this sorts of things. Step 2 is gather your financial data and define your goals. And so again, this is where we actually talk about your situation and gather the necessary documents. And again, that's what the filling out the spreadsheets is today. And so this is where we kind of take a snapshot of your finances. Once we've done that, is that we analyze and evaluate your financial status. So again, we look at the big picture, look at all the details, and then we come up with an actual financial roadmap. And so, what I was going to mention to everybody here on the workshop here is that if you guys are, if you actually fill out the R-Factor questionnaire and you actually fill out your financial spreadsheets, each person on this call has the opportunity to kind of sit down with me on a one-on-one basis at no charge, and I'm not soliciting my business, to actually review all your, all your stuff you want to go over, and I'll actually help you kind of create your own financial roadmap. So, please fill out the evaluation at the end, and if you want to sit down and get together at some point, just kind of check the little box. And you guys on the call, if you wanted to do that, I do tons of go-to meetings all over the country. So I get them, a lot of people in Austin and Chicago and all over the place. So you certainly are included if you're watching this presentation on the webinar. So, and during that, we'll analyze and evaluate your financial status, and also we will actually go over, accomplish step 4, which is kind of recommend things to do, and we'll identify all these different areas, and then at the next part is like, okay, so now it's not time to put some more money in the savings, maybe some investments, maybe it's time to get some insurance, maybe it's time to pay down some debt, or whatever it is. Again, it all depends on your situation. You guys drive the boat here. We can help you kind of implement your recommendations if you like, or if you're working with an advisor, you can certainly work with them to do things. We just want to make sure that you have a way to actually, engage the gears and move forward if you want to implement what you want to do. And then obviously we kind of monitor your financial recommendations, annually, if you like. So that's the process of the kind of financial planning, and we'll take you through steps 1 and 2 today. And then if you want to get together afterwards, we can tackle steps 3 and 4. And that's sort of the whole point of this, is that we're going to have actionable items that you can walk away from and actually put into place, and so you can reach those goals that you want to do in the next 5 years. Does that sound like a good plan? Okay, excellent. Any questions up to this point? Smart crowd. Okay, great. Well, I'm going to dive right into the financial spreadsheets. So you guys, so I guess you guys here in the room and you guys on the call, if you have your these Excel spreadsheets, go ahead and kind of get them up. So again, if you want to kind of split your screen so you have yours on one side and me on the other, that might be a good way to kind of follow along. The other thing I was going to mention is that I think we emailed this Word document, how to fill out your financial spreadsheets. So the first thing that you want to do is you want to gather this information. If you brought it here today, that's great. We'll be very efficient with the time. If you didn't, go ahead and gather this stuff. A pay stub is really important because it's going to have a lot of deductions, all your taxes, your 401k, your health insurance, disability. So sometimes you may be putting some money directly direct deposit into your savings account, but your pay stub will show that. It also gives us an idea how much to withhold for taxes and what your gross income is going to be. Debt, you want to pull your most recent statements from your mortgage, credit cards, auto loans, student loans, and lines of credit. Like literally pull the statements. Just don't say, I think I owe $100,000 on my house. You grab the actual statement. That's really important. You also want to grab all your account statements from your current investments. So, you know, grab your statement from your, you know, your bank account, your 401k, IRAs, annuities, stocks, bonds, savings, all that kind of stuff. A lot of you can do this stuff online, so just kind of, I like to kind of download a PDF file, and so you have it right there. Then also grab your most, you know, if you have any insurance policies, you know, you may not have life, disability, long-term care, but if you do, grab the actual policies because you need to see if that is going to be enough. So the other thing too is that I'm up to like 27 pages on my passwords for my personal and my business stuff. So you know, I'm not sure how you guys keep up with your passwords, but it's always a good while you're doing this, you know, make sure that you have your passwords for stuff. The other thing too is that I know Social Security for many of you is way down the road, but you also need to log into your Social Security account, which is ssa.gov, and make sure that you have your username and password to log into your Social Security. That may not be important when you're in your 20s and 30s, but it's certainly important in your 40s, 50s, and 60s. Okay? So, anyway, you can always refer to this Word document right here. All right? So, I want to give you a little orientation. At the very bottom, you're going to see these different tabs. You know, we have Read First, you know, Income and Expenses, all these different things right here. And obviously there are more tabs than you can see on the screen. So what you can do is that in the lower left-hand corner, you can hit this little right arrow and fast forward all these tabs. And if you get down to the end, let's say you're doing your Roth 401k, and you want to get back to the beginning, you can hit this little vertical line with the arrow, and it takes you back to the beginning. So anyway, so what you want to do, you don't have to do this right this second, but you can if you like. This is just for me to quickly gather data. So again, you put your name, marital status, date of birth, and all your basic information. If you have a spouse, you put your spouse. If you have kids, you put your kids. Again, if retirement planning is way down the road, this may not be important to you. So, you know, I'd say if you're in your 20s and 30s, you probably don't have to fill out when you want to retire. Typically what we do is that if you're born in 1960 or later, your full retirement age for Social Security is age 67 currently. The chances are that at some point there needs to be Social Security reform because it's not as solvent, actually it's insolvent right now. So the chances are they're going to probably raise the Social Security age, which is the age you can receive your full Social Security without a reduction. And so, so for retirement projections, we typically use the age 67 if you're born in 1960 or later as the retirement age. So you may want to just kind of put that in there. So you can use these financial spreadsheets just to take notes. What I did was, I just kind of did a sample right here, but again, you have a copy, so you just fill them in and make notes as you feel fit. Again, your estimated Social Security, you're going to get that by logging into your Social Security account. Again, if you're not in retirement planning mode, you don't really have to answer these questions. Do you have health insurance? I assume that you do through your company. This is where you look on your pay stub. Do you have disability? Is the company paying for it? Are you paying for it? And so if you do have it, then what you can do, you can just highlight this and delete no. You know, done. So you say, yes, I have it. So, you know, again, you can edit all this stuff. So just kind of edit to your liking, okay? Chances are you guys do not have long-term care insurance. And the other thing, too, is that chances are, you know, being young, you probably don't have a will or done any estate planning. So that's something that is important, but it's probably not the highest priority at the moment. And again, are you contributing to your employer's retirement plan? You probably are. Hopefully you are. There's also other places here in the spreadsheets where to put your contributions for the 401k. If any of you formerly worked for a state or a federal government that has a pension, you would actually kind of type in your pension stuff right here. I assume that most of you have not or will not work for the federal government or a state, but if you had some sort of pension, you would kind of put that in there. Okay. The rest of the stuff is really about pension stuff. I did a lot of work with teachers and federal employees, so this may not be relevant to you. Okay. The next thing is the income and expenses, which is, we'll probably spend the most time on this. Okay. Now, again, I made up a fictitious person, and I just threw out numbers randomly in here. Okay. So I just plugged in stuff just to kind of give you an idea on how to do things. So this is probably the most important part of this whole process, because you got to know what your cash flow is. What can you afford? What can't you afford? So one thing you'll notice that you'll see a bunch of stuff in red, like all this debt, the insurance. So anything in red, you're not going to fill out. It's going to pull from another tab in the spreadsheet. The second rule is do not ever type in the annual numbers. See, if I type in, if I click cell C3, you're going to see a formula right here. And what that means is that all we're doing is multiplying B3 times 12 to get the annual. So what you do, if you guys know your gross annual salary, or you have your pay stub, you take that gross annual salary and you divide it by 12 and you pop a number in there. Okay? So if you guys want to do that, go ahead and do that. Okay? Now, if you have a spouse, do the same thing for a spouse. Again, if you want to kind of type your name in there, you can do that as well. You probably don't have Social Security or pension income at this point. If you happen to have rental properties, that's where the real estate income would come in right there. If that's not the case, you just leave that blank. Okay? So this is what's coming in here. The income sources, everything else is so this is all the money coming in. The rest is the money coming out. Now, the reason why I told you to get a pay stub is because on your pay stub, see, there's two different ways you can do this. You can either look at a pay stub and see your withholdings for federal, state, FICA, that kind of stuff. And if you guys get paid, I think you get paid 26 times a year. 24. Okay. So what you do is that you add up federal, state, FICA, Medicare, and you add that up, multiply it by 24, and then divide by 12. And that is the monthly amount right there. Okay. So again, that's important because you got to account for the taxes. In terms of the savings, is that how much? Again, you'll find this on your pay stub. How much are you putting into your 401k? Out of curiosity, is anybody here? You guys putting money into the 401k? All three. Okay, I got 100% participation. At least you in the room. Okay. So what you do is that you get to put the dollar amount in there. Now, one thing that you obviously would like to do is the rule of thumb is to put a good, 10 to 12% of your salary in the 401k. You may not financially be able to do that at this point. So if you're doing, let's say, 5%, put down 5% and have maybe the goal next year to put in 6. And if you can maybe kind of ratchet up 1% a year, that's always a good way to kind of slowly increase your contributions. Does that make sense? Okay. This is also a place to put in for your savings. So one of the things that we kind of talk about is kind of building a cash cushion. So if an emergency comes up, you got to have a huge repair on your car or whatever, it's better to have that come out of your savings account versus paying 20% on a credit card. So building that cash cushion is very important. So how much are you putting into your savings account every month? You want to put that down. If there's other savings, obviously you can put that down. So again, what we're trying to do is just trying to kind of budget where to kind of put money in. And so the other thing too is that, let me ask you this, what happens if you don't pay your rent or your mortgage? What are the consequences of that happening? Anybody? So, okay, you don't pay your rent. What do I do as a landlord to you?
You go to collection.
Okay, and then what happens then? It's on your credit report.
Yeah.
And how does that, so you have a big black mark on your credit report. How does that affect you from that point? can't get loans, or the loan or the interest rate is higher. And so when you rent an apartment, do they look at your credit score? Yeah, they do. So so people kind of rank not paying their rent is really high. That's one of the things that they always make sure you do. I want you to have the mindset that you're going to pay yourself first, which means that there's no one more important than you. So when it comes down to putting away money in your investments, your savings, your 401k or whatever, you need to put yourself as high on the priority list as your landlord or the mortgage company. Okay, so this is really important, because otherwise you're not going to reach your goals. It's very easy to spend money on fun stuff and things, but again, you've got to put your savings as a part of the expenses in your budget, or else you're not going to reach those goals that you want to do in the next 5 years. Does that make sense? So again, I'm trying to get you in the mindset of the importance and where to prioritize where you're spending your money. Okay, now insurance. This is actually going to kind of pull from, there's an insurance tab right here. I'm just going to click on this. So do you guys have, does the company pay for group life insurance for you guys? Okay. Do you have the ability to get more if you wanted to?
Yes.
Okay. So so do they give you like one-time salary?
Mm-hmm.
Okay. So if they give you one-time salary, so let's say in this case the guy makes $60,000, so here's $60,000, and I just made it up just to plug some in there, but let's say you have a death benefit of, let's say 100. Why is this doing it? I didn't do. There we go. I had the right number here. So let's say you got 2 times your salary, and it costs you $30 a year. I'm just making it up. If you plug that in and you go back to income expenses, it's going to show up right here. Okay. So in the life insurance tab, if you have your own, let's say you've got a term policy here, and it costs you, I'll make it up, $500 a year, and you've got $500,000 of coverage, and so that's where you would kind of type in the life insurance stuff right there. So anyway, you can see when I type in the annual premium right here, the monthly premium gets calculated right here. Does that make sense? I'm just kind of showing you where this stuff kind of pulls. So we got the life insurance. I'm just going to I'll just leave that where it is. Okay. Again, so this is where you look at your pay stuff for the disability, the health insurance, that kind of stuff. Discretionary spending. We got charity, personal care. So personal care, let's say you get your hair cut, you get your nails done, you go to CVS, whatever. Sort of just a broad bucket to kind of like your personal stuff. Dining out. So dining out includes both going out to restaurants and bars on the weekends, but also going out to lunch here during the work week. Okay, so when you actually add up the amount of money that you guys spend on food and drink over the course of the month, it adds up. It's still a pretty big expense for most people, and that's one area that you may be able to cut back a little bit, especially living in DC when you get one glass of wine that costs you $12. So anyway, again, you're going to be plugging in all this kind of stuff, and again, with gifts and vacations and stuff, try to figure out the annual dollar amount and just divide that by 12. It's going to fluctuate. It's going to, vary, but definitely you want to do that. And as you're going through this stuff, kind of think about this stuff and plug in these numbers in your spreadsheets. That's kind of the purpose of this, so we can kind of plug this stuff in, so you just save time doing it later. So here is, I'm going to come back to the loans in a second. So we also have, here's the rent. If you have homeowners insurance, property taxes, maintenance, all this kind of stuff, all these utilities, you're going to plug in the monthly amount, and again, you plug that in, and the annual will calculate. Transportation. So I've met a number of people here who live in the DC who don't have a car. They just use Uber or the Metro. So you want, instead of the fuel for this and that, you could actually type in Metro or Uber and kind of put that expense in here. Does that make sense? So obviously, if you don't have a car insurance and all this kind of stuff there's going to be zero. Here's groceries. I've been seeing really low numbers from people. I've been seeing people say, I only spend like $25 or $50 a week. I'm going, really? So groceries, I don't know. So you know, just be careful about what you're spending on that, and try to be as accurate as you can. So anyway, these are these other living expenses. Now again, you're going to see right here a negative cash flow, primarily because I put in the life insurance. I kind of put this $500 right here, so I'm going to kind of zero that out. But my point is that this is just a very rough calculation, but it's important because you need to know what you can afford. So if you're telling me, like, I needed to save my cash cushion so I have 6 months of living expenses in my savings account, okay, how's that going to come? How are you going to do it? How do you know how much you can afford? Well, you got to fill out these spreadsheets to do that. See what I'm saying? So if you've got, so the next, okay, so I want to go on to the next tab. So we also have the financial statement right here, so this is what I call the report card as an adult. So we have the income and expenses, and we also have some cool little ratios right here. As you fill them in, are you kind of within the, you know, are you where you should be? And then we have assets and liabilities. Assets are what you own, and liabilities are what you owe. And so you can see right here that we have a net worth of $1,388. So we can see this person has a lot of student loan debt, has some money over here, and we said we have a Honda Civic. You can put whatever car you have. But what we also want to do over long term is that we want to increase the net worth. So how do we do that? We actually either reduce the liabilities or build the assets, or a combination of both. So we really need to look at both sides of the fence. Okay? So as we fill in all these different slides or these tabs down here, you're going to have your financial spreadsheets are automatically going to populate, which is really, really important. Okay? Next thing is that we have a matrix. Okay? This is also important. The matrix will also be populated as we fill out these other tabs. So the matrix will break down your investments into an asset allocation and a tax allocation. So what the asset allocation is that we break down between cash, fixed income, and equities, and also real estate will fit into the equities. And if we have you know, 3 tax baskets: taxable, tax deferred, and tax free. So I'm going to cover this stuff really quick just to make sure that everybody is on the same page. So what's important to know are the 3 tax baskets. And the reason, so we have 3 of them. One is called taxable. So what a taxable account is basically anything that's not in a retirement account. So, and it's also called, the technical word is what we call non-qualified. It does not qualify for a current year tax deduction. So a taxable account is also called a non-qualified account. And so your savings are going to go in there. And so the way it's taxed is that at the end of the year, you're going to get a 1099, and you're either going to be paying either short or long-term capital gains when you have capital gains and losses. And so you'll be paying taxes, but the advantage of that is that it's 100% liquid, that you can tap into it, you know, when you need to. So thanks for coming. So anyway, so the taxable stuff is important. If you're going to be saving for a down payment of a house, for college, for general savings, for a car, it's going to be in a taxable account. Okay? So the advantages of that are liquidity. The disadvantages is that you're going to be paying short and long-term capital gains along the way every year. Okay? Tax deferred, so that's your typical traditional IRA, typical traditional 401k. So the reason why this is important is because for every dollar that I contribute into my 401k or my IRA is a dollar deducted from my taxable income. So if I had simple math, if I made $100,000 and I put in $10,000 into my traditional 401k, my taxable income would drop from $100,000 down to $10,000. Okay, so the advantage of the tax deferred account is on the front end. So I make 100, I put in 10 in the traditional account, my taxable income drops down to 90,000. All those gains will grow tax deferred. And that could really make a huge difference over decades. Okay? Now, what happens when we pull the money out? Anyone? What happens? How are you taxed when you pull the money out of an IRA or 401k? Okay, you are taxed at your ordinary income tax bracket, and we don't know what it is. Okay, so again, I don't know what my tax bracket will be in 20 or 30 years from now. So the disadvantage of the tax deferred is that you never pay taxes on the first place, and all the money that you take out will be fully taxed at your ordinary income tax rate. Now, if you want to tap into this money before you're 59.5, you're going to be paying a 10% penalty plus the taxes. So they take an extra. It's an extra shock to the financials, to your pocketbook, where you're taxed at your ordinary income tax rate plus a 10%. Okay, so that's not so good. Now, there's a thing. So, do you have to take money out? Out of curiosity, do you have to take money out of a traditional IRA or 401k at some point in your life? Yes or no? Do you have to take money out of your 401k? Let's say you're 75 years old. Does the IRS make you take money out of your 401k when you reach that age, even if you don't need it? The answer is yes. Okay, it's called a required minimum distribution. Okay, it's called the RMD. So what happens is that once you turn 70.5, the IRS says, hey, listen, we let you grow this money tax deferred for all these years. I want my money. And there's an actual, we have actual, there's a schedule that you look at your account value on December 31st and you divide it by a number, and it tells you how much money you need to take out every single year. So the disadvantage of the traditional 401k is on the back end. Okay, you have to take money out once you turn 70.5, and it's fully taxed at your ordinary income tax bracket. Any guess? Does anybody want to guess what the penalty is if you don't take it out? Does anyone want to just guess? So if I don't take my R&D, what is the IRS? What kind of penalty will the IRS give me? Just take a guess. 10%. 10%. What do you say? Higher. I'll give you a hint. It's higher. 25%. What if I said it was actually double that? It's actually a 50% penalty. So if I'm 70.5 and I didn't take money out of my 401k, they say, Jim, you know what? Ignorance is not a defense. I know you're trying to, whether you did this intentionally or unintentionally, we're going to pay you a 50% penalty, plus you got to take the money out and pay full income taxes on it. So not being aware of the law is not an excuse in the court of law. All right, so that's why I'm teaching to you at a very young age, and hopefully this will be one thing you remember from this presentation. And tell your parents this about the required minimum distributions, okay? You can actually show your parents something if they don't know this stuff, okay? So just to recap, tax deferred, the advantage is on the front end, not the back end, okay? We have the final tax bucket, which is income tax efficient or tax-free, okay? So let's take another example, same example. I make $100,000, I put in $10,000 into my Roth 401k account, which, by the way, you guys have one. All right? So do I get a current year tax deduction with a contribution to a Roth? Yes or no? So show of hands. How many people think you get a current year tax deduction if you put money into a Roth IRA or Roth 401k? You think you get the tax deduction? All right. How many do you think you do not get a tax deduction with the Roth? Okay, you're correct. So if I make $100,000 and I put in $10,000 into my Roth 401k, I do not get a current year tax deduction. Okay? Roth IRA is going with after-tax money. So now the difference is that money, just like the deferred, grows on a tax-deferred basis, but when the money comes out after I'm 59.5, I do not pay income tax on that money. Woohoo! All right, no income tax. Do I have to take required minimum distributions? No. Okay, so that is important to know. So let me ask you this: when you quote unquote retire and you're living off your Social Security and all your lots of hundreds of thousands, if not millions of dollars in your investment accounts and you're pulling money out to live on in retirement, would you rather pay taxes or not pay taxes on the money coming out? Okay? But would you rather pay less taxes today or more taxes today? Well, okay. So the IRS is going to get you one way or the other. Okay? So that's what I'm saying is that if you got money in all three tax baskets, you're making the best of all situations. Okay, that's my point. I wanted to spend some time on so you guys really were up to speed on how these tax baskets work. Okay, this is really important. It's not how much money you make; it's how much money you keep in your pocket once you actually take the money out. Does that make sense? Okay. So moving on, we're going to talk. So I'm actually going to come back to liabilities. So down here we have all these different tabs. Okay.
We just have about like 25 minutes.
We got 25 minutes. I got it. All right. So here we go. So see this tab right here called savings. So what you can do is that you can double click on it and type into it and title it. So if you got a bank, or if you have an account at Bank of America or Wells Fargo or M&T or whatever, you can just type in the name of the bank right there if you want to. Okay. And also you would type in the name of the bank or savings right here in cell A1. So in this example, I've got $7,500 in cash in my savings account. Okay. Now, what happens is that I got cash here, and I go back to my matrix. You can see that the $7,500 shows up here in box number 1, which is cash. That makes sense? So as we enter this stuff, and just to kind of give you an idea, so let's say we had $2,000 in bonds. All I do is I go back to matrix, and you can see there's the $2,000 that just kind of shows up right there. So as to, if you want to type in the amount of money that you have in your savings account roughly, go ahead and type it in to the savings right here in cell D3 because it's in cash and it's in that first line. So you can actually type in savings right here if you want to, and there it is. I'm going to get rid of this because I'm just going to kind of get back to the where it was. Okay, so if you have any accounts that are not retirement accounts, you have these different accounts down here. So just to kind of take you through this, so let's say you have a Vanguard mutual fund. I'm just making it up. So you just type on that, and we're going to go up here, and we're going to say Vanguard. I hit enter, and let's say I've got $5,000 in XYZ mutual fund, and let's say it's the Windsor 2. I can spell that correctly. There we go. There we go. So you just type in the name of the mutual fund, and you have a list of all the different stuffs. If you own a bunch of ETFs, let's say you have SPY, and you have IJR or IJ whatever. So you can type in all the different tickers, and you put in the dollar amounts right here. So as you do that, these are all in equities, and here's some equities right here. And let's say you've got a bond fund. Oops. And then let's say the bond goes right here. Okay, so let's say I got $5,000 in my bond fund, and let's say I got a little bit of cash. I'm going to say cash. So what I'd like to do is I like to kind of break down within these caches. Let's say I got $1,000 in cash in my in my brokerage account. So when I enter this kind of stuff in, voila, it shows up here in the matrix. Okay, so I'm just kind of taking you real quickly on actually how to enter the stuff in. So that's why I take my investment statement, and I get all the different positions. If you want to actually get the ticker symbols, the number of shares, you can do that as well. It's not necessary. The main thing is to put the dollar amount and put it in the right asset class. Okay, because if you put these in the right places to begin with, the matrix automatically populates. Okay, really cool stuff. Now, again, I'm going to fast forward right here, and I click on the Advisory Board 401k. So here's Advisory Board 401k, and right here, okay, this guy is in the 2055 target date fund, and has a current value of $9,756, and they're currently putting in 55% of their salary, or $250 a month. If you want to put your employer's contributions here, you can if you like. But you can see again, you want to kind of put this stuff in here, and you got to make sure that you have whatever funds that you have in the right bucket. And again, we go over here, a couple things right here, and here's your, so let's say you have your Roth 401k, and you're still in the 2055 target date fund. Let's say you got $1,700 in that. And again, I go back here to the matrix, and you can see it shows up in two different places. Here's my Roth 401k, and here's my traditional 401k, and here's the dollar amounts. Okay? So again, grab all your investment statements and your savings, and just, and go ahead and again, double click on the tabs down here, tile it the way you want, and enter that stuff in. That seems pretty. This is the one area where people kind of screw up. But does that make sense? See why we're doing that? Okay. And so I'm going to focus on two other areas, and I may be able to end early. Okay. So here's the liabilities. So liabilities are a bunch of, let's say, I got a bunch of student loans right here, and I got a Visa card. So again, you want to grab your statements, look at all your debt, what you're paying per month, the interest rate, and how much time do you have to actually pay it off. And so just by looking at this, this person owes $1,800 on their Visa card, but look at the interest rate at 22% versus the student loans at 6 point something. So again, the rule of thumb is that you want to focus on the highest paying debt first, right? Because I kind of use my shower analogy, okay? So if I want to, I'll go back to my financial statement. I want to build the bathtub of my assets right here, okay? So think about your bathtub and the shower, okay? The water that comes in the shower head is the amount of interest or rate of return that you're making on your savings and investments, okay? So let's say the water from the shower head is growing at one gallon per day. The problem is, and that's in your savings account, maybe making 1%. The problem is that you've got these liabilities drain the bathtub at 22 gallons a day. So that little money that you're making in your savings account is, yeah, it's helping, but it's not helping all that money that you're being charged on your interest. You see the analogy right there? So one of the questions is, okay, do I pay down my debt or do I put money into savings or my 401k? Okay, what kind of rate of return can I get? So if you've got a ton of debt, one of the things that you probably want to do is really focus on reducing that. Now, you still need to fill the bathtub, so you still need to put some money into savings and your 401k, but this is where we kind of talk about in a one-on-one meeting, is that what percentage of the cash flow at the end of the month should go into, what? So right here on your income expenses, you can see that here's a monthly payment that's going into your liabilities. So you're basically paying right here like $1,030 a month, and you're putting in roughly $350 a month into savings and 401k. So that's going to be sort of a one-on-one decision that you have to make. Okay, well, can I maybe back off my 401k a little bit or back off my savings a little bit while I'm kind of emphasizing paying down this debt? But again, it's not like a clear-cut black and white decision to make. You just have to look at that, and there's a lot of stuff to consider. Like, how much risk are you taking in your investments? What kind of rate of return do you think you can get? One thing about paying off the credit cards right here is that I cannot guarantee you a 22% rate of return in the stock market. I can't even guarantee you a 6.8% in the stock market, okay? But I can guarantee if you pay off that 22% credit card, that interest rate's gone, right? So you have to look about the risk involved about putting money into investments versus paying on the credit cards. Does that make sense? So there's some risk analysis on that we can look at. Do you have any questions at this point, Kelly? Do we have any questions online? Nope.
About 15 minutes left.
Got 15 minutes to get it. And this is great. I may even in early today. This is good. So we got the liabilities right here. Another thing we have is that we actually have the real estate. So again, I'll just kind of fill this in. So let's say I own a house that's $400,000. and I owe $350,000 on my mortgage, and I've got a $2,500 mortgage payment, and my interest rate is 4.5, and it's a 30-year fixed, and I've got 28 years left on this. Okay. Now, let's say I've got a rental property, and the value is $300,000, and I still owe maybe $240,000, and my monthly for the extra. Let's say my mortgage on that is $1,700, and I still got, let's say, 4.5, and it's a 30-year fixed, and I got 25, and then I got let's say $2,100 of income from my tenant. So it's cost me 17, and I got 21. So that's a that's a $400 difference. And if you go to my income and expenses, it shows up right there. All right. So if you got the real estate, you can type this stuff in there. So anyway, so that was I pretty much hit all of the main tabs in the spreadsheets. Okay, so I'm just kind of wrapping things up a bit. As I said, you guys have already filled out your R-Factor questionnaire. Hopefully you filled out a little bit of this here today during this workshop. But again, I go back to my little sheet right here. If you don't have all this stuff, go home, grab this information right here, and that way at least you have the documents that you can pull, enter into the spreadsheets. And as I said, for those of you who want to set up a time to get together with me, I'll give you an hour of my time, and all you got to do is check little box yes on the evaluation. And the other thing too is, again, I could use your feedback. Tell me what you like, what you didn't like. But again, I covered a lot in a little less than an hour and a half. We again talked about the R-Factor. We talked about what you need to do to do due diligence on financial advisors. We talked about the financial planning process. We also talked about literally how you take a snapshot of where we are. So if you like that or don't like it, just give me your feedback. Are there any financial topics that you'd like to learn about in the future that would also be important? Again, we got one on mortgages and real estate next Tuesday. The other thing is that I'm working on an investment workshop that basically talks about the risks and actually how to invest for both long-term and short-term. And if you have some interest in that, kind of mark that down. The other thing too is that if you know of any other individual or company who could benefit from a no-cost SOFA workshop, let me know. I gave this workshop about a month ago to the Woodrow Wilson Center, and a number of those employees work for other, they were on the board of Wellesley College or a part of the Young Professionals International group. They're close with their old high school that sometimes they come in there. So if there are other organizations or nonprofits or churches or whatever that you can think of, write that down, and again, we can do one of our 30 workshops. And again, if you like to take advantage of the complimentary consultation, just check yes right here, and make sure that you have your phone and your email, because I'm going to follow up with you, but make sure it's legible, because sometimes I get this stuff, I can't read what people write. And also the best time to call. So I typically reach out by email first, and if I don't reach you by that, I'll follow up a little later with the phone call. So I actually finished under my time, Caleb, and so I'm going to open up to the floor to any questions. So you guys on the call, if you want to type in any questions, I've got another 10 minutes. I'm happy to hang on the phone with you guys. You guys in here in the live conference room. Do you guys have any specific questions that I can answer for you? None at all. either I did an incredibly good job or we have an incredibly smart group of people. I think it's a combination of both.
Hold on, we do have.
Oh, we have got a question.
Someone is asking, how should they connect with you? How should they send you the evaluation form if they are listening online?
So the question is how to email to me. The best way to do, go to my website, jimmusgrave.com, and click on Contact. And right here is my email address. It's just jim.musgrave@rfsadvisors.com.
And we can also send that out to everybody as well.
Yeah. And do you guys have like a SurveyMonkey thing? So you're going to send that out today?
Yes.
Okay. So
There's tomorrow.
yeah. So there's also a SurveyMonkey. If you guys could fill out the SurveyMonkey, that would be, or either one is fine. But I kind of like the SOPA workshop. If you can, just kind of email it to me or something like that, that'd be great. For compliance reasons, I have to report how many people attend the workshops and have this stuff. By the way, this is really important. We're dealing with financial stuff, which is very important and also is very confidential. So I do not share any of this information with anybody, like in the story. So at some point, if you do decide that you want to set up a time to get together, I will actually send you an encrypted email. And all you got to do is create a password one time and just reply to that email and attach whatever you want to attach. And that way, your information is encrypted and safe from prying eyes on the internet. But I take security and this stuff very, very seriously. So, so before you send a bunch of personal information, let me please send you an encrypted email, or you send me an encrypted email. I don't care. I just don't want anybody's information to get out there and be hacked for any reason. Anyway, again, I got great resources here on my website. You can go to the contact me page. Again, it's just jimmusgrave.com, and that's my contact information right there. Any more questions online, Caleb?
We do have one. Someone wants to know, do you think paying off a mortgage early is a bad idea if the property is to become a rental?
So the question is paying off a mortgage a bad idea if the property is going to be a rental? So again, I go back, that's a great question, and there's not a clear-cut answer to your question. A lot depends on your personal liabilities right here, what you own. So here's the thing. There are very few tax breaks that we get, okay? One of the few tax breaks is putting money into our 401k to accrue your tax deduction. The other one is mortgage interest deduction on our mortgage. So the interest that we pay when we have our mortgage is tax deductible. Now, I'm all for reducing debt. The question is that at what is the mortgage interest rate that you have on your property? And I mean, it's tough. Again, it goes back to what kind of risk are you willing to take in the stock market? So
it says that the rate is 4.87.
4.875. Okay, so that's a reasonable rate. There's not a black and white answer to your question. I'd have to kind of sit down with you and look at stuff because there's other variables that you have to take into consideration. One is cash flow. The question is, okay, so the thing about this, if you're going to pay off your mortgage early, that means you're going to be paying extra principal payments, right? So let's say you pay an extra $200, $300, $400, $500 a month towards that mortgage. Okay, that's great, but that's money that's being taken away from the savings. That's taken away from paying that other debt. It's money taken away from put in the 401k. So you have to look at the opportunity cost of where that extra principal payment's going to. So that's what I'm saying is that it's not a clear-cut answer to that question. Now, if you were paying, I 7, 8, 9% in the mortgage, whereas it's definitely high. And considering what the stock market is doing, I would definitely say paying down the mortgage would be a lot more attractive at higher interest rates. But still, you're paying less than 5%. That's still a reasonably low interest rate. So it really all depends on your situation. Me personally, I'm actually paying extra principal payments to my primary residence. I'm paying an extra $500 a month on my personal mortgage, but I will be paying off a 30-year mortgage in 20 years as a result of that. So I like the idea of kind of paying down the that debt. If you want to accelerate it, just make sure that you look at you have to look at the opportunity cost about where that money could go to other places. I think that's probably the best answer I can give you on that. Do you have a question? No, you're just stretching.
Yeah.
Any other questions?
Not right now.
Not right now. So I'm accessible to you. You've got my contact information. Hopefully you fill out the evaluation. I think that's about it. If there's no more questions, I guess we'll sign off. I wanted to thank you for spending your time. And the other thing too is that if you think that this workshop was valuable, let Caleb and other people in human resources know. Obviously this was valuable to other people, otherwise they wouldn't have me back. But if this is valuable to you and you think this is good and other people would benefit, let them know. So that'd be good. And again, if there's other people that you think would benefit from a SOFA workshop, please put that on the evaluation. I'd be happy to set one up. It probably has to be in the DC area. I can't really. Actually, no. SOFA, we're a national organization, so if you're in Austin or another city, we could probably get something set up with another advisor down there. We good?
Yeah.
Thank you guys so much for attending, and go have a nice lunch. And I'll be talking to you guys soon.
For those of you on the call, thank you all for attending. We will be sending out the SOFA form that Jim was talking about. So if you're interested in meeting with him in person, you can still get that opportunity. Thank you all again for attending.